Hey everyone, it's Kirk here again at Option Alpha. So, one of the reasons why I personally love options trading is because you can be wrong at stock picking and still make money with options. It's one of the best things I think about options trading, and one of the reasons why I love options trading because I'm not a good stock picker, and because if I'm wrong on a position and an assumption about where a stock is going, I can still make money with an option strategy. So let me show you how it works just at the very basic level. This is a concept that is often missed by a lot of new traders when they get into options trading, but it's super, super important. So here we have a payoff diagram, and let's just draw some very crude numbers here, but let's just assume that we have a stock that's trading at, let's say, $55. So right now, the stock price is $55 for each share. Now, the problem I see with stock trading is that once you get into the trade, your line in the sand is your entry price, and it's either make it or break it. And for a lot of traders, that's a good thing. I personally don't like that necessarily because I like options trading that gives me a little bit of wiggle room in case I'm wrong on a position. So if the stock is trading at $55, what you can do if you're going to buy a stock is you're basically setting up your break-even point right at $55. So if the stock goes up in price, then you obviously make money, right? So if the stock goes up to say $60, then of course you capture that whole difference up there. But the problem is that it often doesn't go exactly the way that we wanted, or we think a stock is going to go up or down, and it doesn't happen. So what happens is that if the stock ever dips below $55, you start losing money. And so what you have is you have a payoff diagram that looks like this, where you make money only if the stock goes up and you lose money if the stock goes down. And so what happens is that this entry point becomes insanely critical. So did you time the market right? Did you get into a position or stock just when the stock was about to go up? Now, you do have the little bit of luxury of time. You can hold the position forever, but that does also mean it can just continue to go down forever, and you can just find yourself in compounding losses. So the way that I like to think about it is with an option trade, because an option trade can be a little bit different, where you give yourself a margin or cushion that if you're wrong on your assumption, you can still make money. So classic example of this is a bull put spread. So in this example here, let's say that the stock is still up here trading at, say, $55. What we can do is, instead of actually buying the stock, we can sell an option spread. And by selling an option spread, we give up a little bit of that upside potential for the ability to increase our probability of success overall. Because what we're doing in this case, if we sell the 50-45 put spread, is we're giving ourselves a margin of error that if the stock actually goes down, goes from 55 to 50, so you're completely wrong on your assumption that the stock is going to go up, you can actually still make money. You still fall into a profitable zone. So if the stock stays the same, you actually make money. If the stock goes up, of course you make money on this position. But the important thing here is that if the stock actually goes down a little bit, depending on how you set up this position, and we'll go through a lot of examples, you can actually make money on this trade. And that's why I love options trading, because I'm willing to give up the really, really big upside potential for a lot more consistency and a lot higher probability of success. So to kind of put a bow around this one, let's just use that same payoff diagram, just shift it a little bit to kind of visually show you. I like doing this because I visually think about this exact payoff diagram just, again, in a real market scenario. So let's say you've got this stock trading up here, right? This is the stock, and you're kind of watching it, and you're here at this point where the stock is trading at, again, about $55. Now, if you were to simply buy the stock outright, right, and you were to buy the shares, you'd buy it at 55. Your line in the sand, your break-even point becomes 55. But with an options trade like a bull put spread here, you can actually sell the 50 strike put, buy the 45 strike put. You got to break even around $49, and this is your margin of error. This is your cushion here that if the stock actually goes down, you can still make money on this trade, because now you have a position where the stock could go up and you can make money, the stock could go sideways and you can make money, and the stock can actually go down and you can still potentially make money on this trade. So if this started to play out in the market environment and you started to see the stock starting to play out, now the stock actually goes down, right? Maybe the stock really goes down and it goes down to something like $47, $48, right? Now remember, if you were to buy the stock outright up here at 55, you'd be looking at some pretty heavy losses on that position. Say nothing of the fact that it would cost you a lot of money to get into that position because the shares are really expensive to buy 100 shares outright versus with an option contract, you're controlling 100 shares per contract. So now the stock has gone down. You were wrong in your assumption, right? And now the position's a loser. Maybe you even just, it's too much for you and you dump the position. But maybe the stock actually does turn around just a little bit and starts coming back up, right? And starts trading in this range and it comes all the way back up to something like 50, right? Now, at this point, you've wasted a lot of time and capital in that original stock position. And again, if you're still trading the stock, your line in the sand is still up here at 55. That is where you have this position. So even though the stock didn't go where you wanted and rebounded a little bit, it still hasn't caught back up to where it needs to be in order for you to make money. However, if you're trading a bull put spread or an option strategy like this one, you actually did find yourself in a position where even though the stock went down net from your entry to your exit or expiration, the stock went from 55 down to say 51 or 52, you still made money overall on the position. And that's again why I love options trading, because it gives you, no pun intended, that optionality, that option to make money in multiple market directions, even if you're wrong on the position. All right, let's look at some positions with some market data just to give us a little bit more context around this. So I'm inside of Trade Ideas, inside of Option Alpha, and I've just got a very simple set of filters that are in here just to give us some ideas. We've got credit positions, ETFs, bullish positions, and we're targeting probability of profit 50% or higher. So essentially trades that are a little bit out of the money for these positions so that we give ourselves a margin of error. So if we look at some of these trades here that you can see, like I'll just pull up this one. This gives us a payoff diagram, which looks just similar to the one that we had showed you in the couple slides ago. But here you can see we're selling the 75 strike put option, buying the 73.5 strike put option. Our break even is 74.23. And right at the time that we're doing this video, the USO was trading at 75.05. And so what you have here is you have this margin of error where if USO actually goes down, it can go down basically until 74.23 until you start losing money on this position. And that's the power of using an option strategy like a spread like this, where you can kind of create these payoff diagrams that fit your expectations and kind of your risk profile. So in this case, the stock could go down and you could still make money. Obviously, if the stock stays the same, you make money at expiration. And if the stock goes up, of course, you make money at expiration as well. Now, the cool thing about options is, of course, you don't have to do it exactly this close. You can do probabilities of success that are a little bit higher. So maybe we shoot for something around 60%. So now this will give us a little bit more margin of error for the stock to go down. But again, we're going to compensate somewhere in an option strategy. So we're going to give it up a little bit in the premium. So we're not going to take in as much premium because we have a higher probability of success. This is that weighing mechanism and system that is inherent in the markets. So this is an interesting example only for the sake of just looking at giving yourselves a margin of error that's a little bit bigger. But here you can see just visually that our break even on this type of position is 59.16 or 59.17 here. I think this is IBIT instead of USO. And you can see that the stock was trading at 60.70 at the time that we're doing this video. So again, you give yourself a much bigger margin of error, a big cushion for the stock to move down. But again, you kind of compensated it a little bit here by reducing your max overall profit. Let's look at some even higher examples here. Let's go up to like say 70% chance of success. So let's go up here and look at one of these. Maybe we'll go back to USO here. Now you can see you've got a much wider margin of error where the stock can basically drop about $2. You can have USO go from 75.05 down to about 73.03. That's your break-even point right here. Again, big margin of error for USO to go down, but you gave up a lot of your upside potential for this. Again, that's that weighing mechanism. You give up a lot of your premium in exchange for a higher probability of profit on the trade. It's not that one is better than the other. It doesn't necessarily mean that you should always do higher probability or lower probability, but this is where you can kind of play around with different strategies and make different payoff diagrams that kind of fit what you're trying to do as a trader. So again, what I really love about options trading is this ability to do what we talked about here, which is to basically build payoff diagrams that give ourselves a margin of error so that if we're wrong on assumption of where the stock is going or where the stock may be going, maybe it just stays still and trades sideways for a little bit, we still give ourselves a chance to make some money on positions. And of course, because options are a leverage product, it means that we can do it without outlaying a ton of capital anyway to buy the underlying stock. So I hope you guys enjoyed this one. If you did, let me know in the comments. Like, share, subscribe to our channel to get more videos and updates. And until next time, happy trading.